So last week, the US began to entertain the idea of a negative interest rate, and with their current low interest rate environment, futures on their interest rate are expected to be negative by January 2021. Now, this begs the question, with our current low interest rate environment, are we heading in a similar direction? And if so, if you're a homeowner, an investor, if you have any debt or use any money at all, you must be wondering, what would this mean? Will I get paid to settle my debt? Will I get paid to borrow money? How does it all work? Well, let's get into it. Up next. Hey guys, welcome back to Money Talks, and if you're here for the first time, thank you for being here, guys. Hit that subscribe button and send us some love by liking this video. So straight into it, what are negative interest rates and what do they mean? Well, basically a negative interest rate is exactly that. The rate goes below zero, and this happens by decision of a central bank in a country. In our country, that is called the Reserve Bank, and yes, I said by choice. You see, the Reserve Bank has the task of controlling interest rates and controlling the cash supply in the economy. And when times are good, consumer confidence is up, people have faith in the future, unemployment is low, people spend money and the economy thrives. And if this goes on, the economy grows and people's salaries start to increase at a higher rate every single year, higher than the interest rate. And so people tend to start spending money on credit, on vehicle asset finance, on home loans, on credit cards, raising their standard of living. And put simply, people spend their future money today, well, because life is good. And because everyone has money to spend today, this causes prices to rise in the economy, and this is called inflation. When inflation gets too high, the Reserve Bank increases interest rates, and this makes credit more expensive. People are left with less money at the end of the month to spend, and so businesses start becoming more competitive and start lowering their prices, and this is called deflation. Deflation is bad, guys, because it stops money flowing in the economy, and so then interest rates start coming lower to encourage spending in the economy, and this is the role of the Reserve Bank, to keep things balanced and purchasing power and inflation under control. Now, to cut a long story short, since the financial crisis and in the last few years of bad economic times and poor governance and leadership in our country, consumer confidence and business confidence and consumer spending just hasn't recovered since. And to make matters worse, we have what's happening at the moment, which has slowed the world down, stopped production in many industries. Global growth has been projected to be half of what it was, and this has caused a lot of unemployment, which means that people don't have money. And people that do have money are not spending it because of the uncertainty and restrictions. And so the Reserve Bank starts to cut interest rates to help people get by in these times, to help them maintain their debt. And more cuts are projected to help encourage spending as the economy opens up in stages. But ultimately, this is all unprecedented and new territory, and it just doesn't seem to be having an effect large enough to boost the economy, and so rates keep getting cut. On that note, keep eyes on the news today, because we are expecting another interest rate cut of anywhere between 0.25% and 1%. This is what economists think, so go check out my video on how the interest rate affects you after this video. So guys, now that you have a basic understanding of the interest rate in relation to the world that we're living in today, if this continues and the interest rate keeps getting cut to ease the burden on the consumer and for the economy, the interest rate can go to zero and can go negative, as we've seen in a few economies around the world today. And so logically, if the interest rate does go negative and all this time you've been paying interest on your debt, surely this means that you should be paid to borrow money, right? Wrong. You see, the interest rate that we see getting cut is known in this country as the repo rate, and that is the rate at which the Reserve Bank borrows money to commercial banks and is a guideline rate that other banks borrow money between each other if they need to. This rate influences your savings rates of the money that you keep in the bank, and also affects the rate at which you borrow money on a home loan or car loan or credit card. The actual rates at which you borrow money is always linked to the prime rate, guys, and the prime interest rate, put simply, is the benchmark of the markup which banks charge to make money on the money that they borrow you. The prime rate is a standard 2.5% above the repo rate. So what does this mean for your home loan, vehicle finance or credit card? Well, yes, your cost of credit will be lower as interest rates come down, but guys, remember that banks are aware of this. They're also very well aware of their margins that they charge to make money. And so any future credit that you may want to take out will always be subject to your credit risk profile. The higher risk client you are, the higher the markup will be to borrow money to you. For example, if interest rates are 0 and the prime rate is a standard 2.5% and you are a high risk client, you might be offered a rate of prime plus 10% on your credit card. And guys, that's still high. And the lower risk client that you are, the better credit risk profile that you have, you'll get a lower rate. But guys, I'm telling you now, there's no way that banks will pay you to borrow money. The other side of the coin is money in bank savings accounts. And if interest rates are negative, theoretically, this means that banks are charged to store the money that they have. Because yes, at a negative interest rate, it costs money to keep money. And so instead of paying to keep that money stored and then paying you to keep your portion of that money that they have in your bank account or in your savings account, they may offer really low savings rates and may increase bank charges so that they can make up some margin on keeping your money. And also encourage you to spend money or invest more money in the market instead of seeing it lose value in cash. They would also rather lend this money instead of keeping it and paying for it to be stored at lower interest rates to lower risk customers. And this lending and spending will get more money flowing in the economy and hopefully help the economy grow. So either way, guys, negative interest rates or not, we are currently in a very low interest rate environment, guys. And coming out of this lockdown, we are bound to see some revenge spending on luxury goods. And this psychologically will happen because we deserve to spend money on ourselves after all of this, putting up with this lockdown. And unfortunately, a lot of that spending is going to be on credit. So the takeaway, I hope, guys, is as much as borrowing money is cheap and could get cheaper if we see interest rates going lower, and yes, spending money is good for the economy, if interest rates keep dropping, guys, let's not forget that your personal finance, your personal circumstances are different to everyone else's. And there is still a journey ahead of you through these times, after these times, to make it financially, live life on your own terms, guys. And the only way that happens if you have an understanding, if you have a plan, if you understand your money coming into your life and flowing out of your life, and of course, stay away from bad debt, guys. The plus side is low interest rates environments may allow businesses and side hustles to thrive. But guys, please don't take this as a license just to go borrow money without a game plan. And if you really have to spend money, guys, think about spending local, support the businesses here in this country, keep the money flowing, and that will help boost the economy. And on that note, thanks for watching, guys. I hope you enjoyed this video. I hope it helped your understanding to think about the future, to think about today, to raise the awareness. Share this video to help people get real in their journey to financial freedom, understand that the world and money and the game plan isn't as complicated as we think. You can always take the step to change your life for the better. All it takes is time, effort, and a little bit of focus. So guys, share this video, like this video, hit that subscribe button if you haven't, and I'll catch you guys in the next one.